Something a bit different now, away from the local company reporting season. A new fund is being marketed to Australian investors, offering exposure to Warren Buffett's famous company, Berkshire Hathaway. It's called the JB Global Berkshire Hathaway Income and Equity Accelerator. And the way it's set up is pretty complex. Rather than investing directly into the A-class shares, the fund puts a percentage of investors' money into call options over Berkshire's B-class shares and invests the rest into a bond to provide capital protection. Justin Beeton is JB Global's CEO and is here to explain how it works and why he developed it. Justin, both very good valid questions, I think. Thank you very much for your time this morning.
Good morning, Brooke.
I mean, investing in Berkshire Hathaway isn't impossible for Australians. It's just quite hard from where we sit, isn't it?
That's right. There's a few risks that you take on by investing internationally. The main one being currency risk that ordinary Australians wouldn't be otherwise exposed to if they were investing domestically. So we mitigate that risk by ensuring we've got a hedge against any currency fluctuations. Likewise, the second key feature is capital protection. That makes it really unique, the first of its kind here in Australia.
And in terms of Berkshire Hathaway itself, why would you say now is actually a good time to get in on that story?
Well, historically, the average return for Berkshire Hathaway over the last 50 years has just been approximately 20%. But where Warren Buffett has really excelled is times following a crisis. So after the global financial crisis, we think this is a great timing to be exposed to such a company, riding off the coattails of Buffett. Like an example of that was his recent purchase of Goldman Sachs back in 2008. Textbook Buffett, and he's already made, I think it works out to be $2 billion from that purchase.
Okay, and tell us how this split works between the money that's invested in the call options over the Berkshire Hathaway shares and then the bond invested into as well. It's a 20-80 split. So
yeah, approximately it's about 20-80, although that being the case, while the bond is there and 80% of the funds go into the bond to ensure the capital protection in 3 years' time, the other 20% goes into a call option to give us a one-for-one return, as if the full dollar invested was in the Berkshire Hathaway shares. So the call option gives us all the upside of the underlying, as if the whole investment was in the Berkshire stock. But by having 80% of the bond, gives us a peace of mind and sleep at night, knowing that even if Berkshire Hathaway share price does fall, the majority of our clients' capital is going to be protected.
Is capital protection something that investors want more now through the global financial crisis? Have we necessarily seen that?
Well, in 2006, 2007, a lot of people criticised us for putting so much money in capital protection investments, although obviously after the crisis and the market falling 50%, the importance of having capital protection was highlighted. So definitely the appetite for capital protection investments has certainly increased over the last few years.
And so you mentioned obviously earlier the currency risk, and there's a volatility risk, I suppose, as well. How do you mitigate both of those?
Okay, so we've got a 100% hedge. So when the investment in Berkshire Hathaway goes up, if it goes up 20%, for instance, we'll be receiving a return 20% in Australian dollars here. So there's no currency risk at all involved in the investment. Volatility is sort of an interesting question with volatility. What we do is we manage it through a volatility mechanism. So when volatility is high, generally the market historically has fallen. So we convert a lot of the investment to cash when volatility is high. Conversely, when volatility is low, we want higher exposure to the underlying, because generally Berkshire Hathaway has increased significantly in value in periods of low volatility.
And I would just go through some of the details. Investors, you're talking about borrowing 100%, or investors borrow 100%, minimum $50,000. It's a non-recourse loan facility. You have to pay, is this right, the first 3 years of the interest up front, so you're looking at about $7,500. I suppose one thing that would raise a few eyebrows is the leverage involved in that 100%. Why have you done that?
Well, see, the leverage is a component where the investment bank is willing to lend up to the capital protected amount. So while it's a high level of leverage, when you combine it with capital protection, especially with a non-recourse loan, we don't get the usual negative effects of leverage. So we get all the upside of having leverage. The downside risk for the investor is the interest expense. Now, with the capital protection in place, that interest expense is 4.95%. So that's the maximum amount that clients can lose, being the interest expense for the full investment. So it's not really a high-risk investment when you overlay capital protection with leverage, provided clients are happy to lose the interest expense.
And I guess you always pay to have protection, etc., and you've set up this fund so that in terms of your fees, you get a 1% upfront fee in terms of the total funds under management, and then you look at a 10% performance fee. As you sell the idea to investors, I suppose you're saying saying, you know, look, we're riding on the coattails of Warren Buffett and Berkshire Hathaway. Where do you actually have value, though, to justify that 10% performance fee in the end?
Well, obviously, we're riding on the coattails of Buffett in that we're going to enjoy all the upside Buffett has provided to his clients for the next 3 years. My expertise is the fact that we're overlaying capital protection. So in Australia, JB Global is the leading company here with capital protection. That's our value add to ensure our clients can have the peace of mind just in case the company does fall. And we're trying to change the industry and lead it into the direction of moving away from trail commissions, those conflicts of interest that exist. So aligning our interest with the performance provided to the end investor, I think is a win-win situation for both the end investor and us as a company.
One bizarre thing, I suppose, for people investing in Berkshire Hathaway is that the analysts often don't like to cover it because Warren Buffett doesn't give a lot of information about the company. He's got his famous letter and the annual notes going to shareholders this weekend. I know that's on Saturday, but he doesn't communicate, he doesn't give guidance. Analysts kind of don't want to touch it. It's kind of a bizarre thing about that company. Is it just in him we trust? Is that how you invest in Warren Buffett's Berkshire Hathaway?
Well, certainly he does keep his cards very close to his chest. And I suppose that's one of his greatest attributes. Although when it comes to his investment philosophy, he's been forthcoming for many years now to let the market know. Where a lot of fund managers have tried to replicate Warren Buffett's investment philosophy, our sort of view is why try to replicate him? Why not just invest in the underlying share itself and then overlay capital protection just in case the share price goes down and the historically performance of Buffett doesn't continue for the next 3 years.
And I suppose the big issue that people still have with Warren Buffett as well, and when we can look at his track record, that's fine, but the succession planning, he doesn't talk about it much. I suppose, again, as we look forward to the letter which comes out over the weekend, people say hopefully he'll mention something about succession planning. He's turning 80 in August. Is this something that will hang over the stock and, you know, until he actually comes out and says something more specific?
Well, he does need to come out and tell the market what the actual plans are, just in case he does pass away. I don't think he's ever going to retire. I think his term at Berkshire Hathaway is going to end when he does kick the bucket, unfortunately. But being 79, some people look at his diet. I've read that he's never had a vegetable in his life and eats peanuts and Coca-Cola for breakfast. So if you followed Warren Buffett's diet, I think you would have passed away many years ago. If you followed his investment philosophy, you would have been a millionaire many years ago too.
Yeah, and I suppose everyone hopes that can continue, and we'll very much look forward to the Berkshire Hathaway annual letter tomorrow. So thank you very much, Justin, for your time. Appreciate it.
Thank you.
Okay, that's another side of things.